Good morning. Mark Ostfeld from ADM Investor Services International with a few thoughts on the government bond markets. We've had some quite remarkable developments this week. And my first chart of the day is the Danish government bond yield curve. Not something one looks at too often, but nevertheless, it is remarkable for the fact that there isn't actually a single government bond in Denmark which doesn't have a negative yield on it. In fact, in terms of the investing universe within Europe more broadly, we have something in the region of about 5.3 trillions worth of bonds which are on negative yields. That's more than 50% of the universe. And so one does actually have to start to think about what the consequences of this are. But let's move on to the next chart or next table, which is a table of 2-year government bond yields in the Europe, Middle East, Africa region. Unsurprisingly, one can see at the top we have the likes of Switzerland and the just aforementioned Denmark, with heavily negative yields around minus 0.1% in Switzerland. Denmark and Germany are also in that same sort of region. The more remarkable part is as one looks down the table and looks at where else in terms of 2-year government bond yields, we also have negative yields. So aside from the likes of your Swedens and your Slovenias and Spains, we also have negative government bond yields in Latvia of minus 0.5%, in Croatia even of minus 0.3%. Somewhere along the line, one has to then end up asking a question here. First of all, one obviously makes the observation that with government bond yields as negative as this, it is little surprise that on every setback in any form of risk asset, be that credit of any particular variety, be it investment grade, be it high yield, be it leveraged loans or emerging market, that we see a big charge for to buy any dip that there is, simply because people are hunting down yield and income. It's also equally unsurprising that we're seeing a lot of companies indulging a lot of financial engineering, because at these sort of levels, why wouldn't you want to borrow, particularly if you are like ING, able to borrow, issue a perpetual bond with a negative yield, as they did the other week with a minus 5 basis points yield on that. But it also then leaves the question about debt jubilees. Debt jubilee is defined as basically writing down a lot of debt, and one wonders, with all these negative yielding government bonds, whether we're actually getting a stealth debt jubilee via the back door. It's just a question to contemplate. It also makes one wonder whether one day in the future, if we keep on driving government bond yields as low as they are, whether the consequence will also be negative dividend yields. So the final thought relates actually how this all plays out in terms of foreign exchange markets. I have 2 charts for you. The first one is the spread between 10-year bunds and 10-year JGBs, where one can see that one now actually picks up 25 basis points almost going out of bund yield, out of bunds into JGBs. Therefore, that should basically favor the yen over the euro in the foreign exchange markets. And for those speculating that the Chinese government will be pressurizing the yuan, the next chart also highlights how we've seen a very sharp recovery in the spread between 10-year US Treasuries and 10-year Chinese government bonds, such that the pickup is now about 122 basis points, which would tend to indicate that as much as the pressures are there from obviously a slowing Chinese economy, that with the Fed apparently set to cut rates, and I would say that there's room for some debate on that, the yuan is likely to be supported by the better yields on offer in its government bond market. So it's just a few thoughts there to think about for the week ahead as we approach a lot of major data.